I've gotten to 12,000 subscribers, which is unreal. So I thought I would do a Q&A. I asked for questions across Instagram and YouTube on a YouTube post that I made. And I got 8 comments or questions on Instagram and 6 comments on the YouTube post. So we're going to be going through all of them in this video. There's a diverse range of topics. And I'll also put timestamps down below if you want to jump between the questions or jump to specific ones. Firstly though, of course, a massive thank you to everyone who has subscribed and who watches, likes, shares, comments on my videos. I genuinely really appreciate it. I think I put out 45 videos so far in 2026. This might be my 45th one, but I'm trying to get to 100 for the year and I'm trying to increase really the quality and the quantity. So thank you for watching. And if you've got any feedback, please let me know. I've invested in this new mic, which is a bit annoying, you can see it, but hopefully that means the audio quality will also be better going forward. If you've got any questions, leave them in the comments and I'll get back to you. If you want me to roast your portfolio, also leave it in the comments below. And the final thing before we get into the first question on bonds is the Investing Academy. This should come out on Wednesday and it's kicking off on Monday. So if you want to get involved, you want help with your investments, take control of your workplace pensions, reduce your fees, all of that good stuff, click the first link in the description and I'd love to help you out on your own investing journey. Anyway, bit of a longer intro. This one's more unscripted. I've got about 14 or so questions to get through and I'm gonna give you all my honest thoughts. Of course, I'm not a financial advisor and none of this is financial advice. With investing, your capital is at risk and this is all just my opinion, but I hope it should help you out regardless on your investing journey. And then now I've got this mic, it's actually quite good that I can be a bit more hands-free of it. I normally mount it and it's a bit awkward. So hopefully the quality is good. If it's bad, let me know. So the first question is from Chloe on Instagram and she says, when I start adding bonds for retirement, is ticker VANGRS the best bond fund? Now I think she means I don't even know how to pronounce it, VANGRS, VANGRSI. That's Vanguard's Global Bond Index Fund. I'll put it up on screen. And it is a 0.15% fee and invests into a massive nearly 15,000 bonds. So I actually do think if you're gonna add bonds to your portfolio, this is probably the easiest way to do it. I take the exact same approach with my stock market portion of my portfolio. And one day, if and when I do add bonds, I probably would add this literal index fund to my own portfolio. The one thing to caveat though, whether you should add bonds or not is of course a different topic, but with this specific fund, it's actually a mutual fund. So it's not available on that many platforms. Another option, which is in ETF form, which is available on pretty much every platform, or it should be, is Vanguard's VAGP, which I will also flash up on screen. VAGP or VAGS. That is actually lower fee, has slightly less bonds, but is very similar returns overall. And that is an ETF version, so it's available on more platforms. I will have a full video coming out on bonds, when to add them, if you should even add them, what I'm gonna do personally with my own portfolio one day. But long story short, that is a great fund choice, Chloe, in my opinion. We'll now go to a YouTube post comment, and this is from Scott, who said, deciding to switch my SIPP from Vanguard to Trading212 to save on fees. What's your thoughts? Another pro would be I could buy fractional shares. So the main 2 advantages of Trading212 over Vanguard is that ultimately it's lower fee. There's a wider range of investment options. There's thousands of ETFs and individual stocks. Not that you actually need thousands, but there's a lot more choice. And there is fractional shares when it comes to investing in those stocks and ETFs. Now, long story short, actually, do you know what? The first thing I'd say is the one downside of Trading212 SIPP, and this goes for all of the low-cost DIY brokers that offer SIPPs, so also Free Trade and Invest Engine, is that they don't offer limited company contributions. So if you want to make contributions directly from your limited company into your SIPP, which is what I do exactly, then those platforms I mentioned will not be possible to use for you. And that's actually why I use Vanguard still for my SIPP. Even though it is higher fee than some of those other options, I can make contributions from my limited company directly into the SIPP. Now, saying that, if you're looking to consolidate old workplace pensions into a SIPP, or you just want to make personal contributions and not limited company contributions, then I would actually say Trading212 is probably overall a better choice if you want fractional shares and you want lower fees, because ultimately it has both of those and Vanguard don't. And what I always say to people is whenever you're picking the best platform for you, start with the end in mind, work out what you want, and you can quite quickly work out the best platform for you. If you want to invest in the individual stocks, for example, Vanguard don't offer them on their platform. There's only Vanguard mutual funds and ETFs. So once again, Trading212 would be better. Now, saying all of that, Vanguard do offer limited company contributions if you are a limited company director. They're also really as big and as good as it gets, I guess. I mean, they've been around for 50 years. Their reputation is pretty impeccable. So I know people do like them because of their brand name. They also do offer mutual funds like that global bond fund and another popular global index fund called the FTSE Global All Cap. So once again, they might be good for some people depending on what you want to invest into. And also a big underrated one is customer service. Now, I use a lot of these low cost DIY platforms because I want the lowest fees possible and I want a wider range of investment choice. But with most of them, I think all of them actually, you can't just speak to someone on the phone. Whenever I speak to people one-on-one, normally older people, they actually really value being able to call up someone if something goes wrong or if they're worried about something, and it makes, I guess, them feel that their money's safer. Of course, all the brokers I've mentioned in this video, and I'll only ever talk about brokers that are regulated, but I think because of that customer service element as well, that's another advantage of Vanguard, and ultimately is why you pay higher fees, really because of that customer service. So if you do value that, then once again, even though Vanguard are high fee, it might be worth it for you. It's really all just personal preference. The next question from Joanna, the hot topic of withdrawing money before pension age among young Brits. What's your take? So I assume Joanna means living off of your ISA before accessing your pension. So with pensions, I guess there's three types to be aware of. The state pension, which is really just based on NI contributions, 35 years worth, then you get the full state pension. That's going up to 67, I think, or maybe even 68. No, 67 it is. And that's coming in soon, in the next year or two. DB pensions are also normally locked up until 60 to 65. But DC pensions, defined contribution pensions, so your standard workplace pensions and SIPPs, normally are accessible in your mid to late 50s, although that age is also increasing. So what I think this question is asking, and what is my opinion, I actually think that's why having a stocks and shares ISA is so good, and it's actually beneficial to have an ISA and a pension, because number one, you can actually access the money earlier. If you're in a fortunate position where you're earning really good money and you can put away a lot of money, you can max out your ISA allowance. I've never done that, but hopefully will this year. Maybe, we'll see. I'm gonna bet a nice on my money from Australia, so I'm sort of cheating. But this year should be the first year I max it out. What else was I saying? I lost my trail of thought. But yeah, if you were contributing to both, of course, with your stocks and shares ISA, because it's fully flexible, accessible, you can get it whenever you want, you actually could live off of that from, I don't know, 45 to 55, and then start accessing your defined contribution workplace pension from 55, and then you might have a DB pension or might get the state pension. So that's almost how you can sort of sequence the actual money you're going to withdraw. Another reason why I think it's so good to have both ISAs and pensions is because if you have two different types of pots, it gives you more options. So the government do come in and blitz one of them, at least you have the other one, but also you can normally make your overall tax withdrawal or your overall withdrawal sort of strategy more tax efficient, because you can, I don't know, use your pension for the first 12.5K and pay no tax, and then take another 12.5K from your ISA, assuming you can live off of 25K a year. So that's why I think another reason having those multiple accounts is good to ultimately pay lower tax overall. So I guess what's my take? I think that's overall, yeah, a good thing to do, to be honest with you. And I use both pensions and ISAs. I actually have about a third of my money in ISAs, a third in pensions, and a third in general investment accounts. And that's why I'm gonna try and bed and dice a lot of that GIA money to get it into my ISA, and then I'll then have my ISA and pension pots growing over time. So what's my take? I think really it depends on your overall financial position. If you've got to a point where you are financially free, your investment pots can cover your monthly and annual expenses, then yeah, you're of course going to interrupt the compounding because you're taking money from your pots. But if you're financially free and can give up work, yeah, then I'm definitely a fan of that. If you're in a position where your investments can actually cover all of your monthly expenses and annual expenses going forward. Okay, we're back now to another YouTube comment. And this one says, if you're using a combination of ISA and DC pension drawdown for tax efficiency, can you still get a portion of your pension withdrawals, or would this not count as a gift from income from a HMRC perspective? I'll be honest, I'm not 100% sure what this question's asking. But yeah, ultimately when you start withdrawing money from your pension, you will pay income tax on that at your marginal tax rate when it comes to a DC pension like you mentioned. And of course your ISA is completely tax-free. I don't think there is any gift element at all with any of those. So if I misunderstood your question, let me know, but I hope that helps a little bit anyway. Another question from Instagram, which is a recommended junior stocks and shares ISA? HL look high fees, all world ETF is the plan. So I would actually say HL are the best provider for a junior stocks and shares ISA. The reason being is that even though all their adult accounts and really all of their accounts are quite high fee, relatively speaking, their junior stocks and shares ISA is completely fee free. So you can actually have one, pay no platform fee. And if you set up a regular monthly investment, there's also no trading fees to pay as well. So if you wanted an all world ETF, Vanguard's one or Invesco's one, or even Vanguard's FTSE Global All Cap, the HSBC FTSE All World, there's loads of options, both ETFs and mutual funds. You can set up a regular monthly direct debit and pay zero fees, which is great. Of course, their adult accounts, though, are high fee. And I think they're trying to lure people in through this way to then get them to trust the platform and then use their adult accounts where there are higher fees there. The only other thing to say as well, though, there's now 2 other fee-free junior stocks and shares ISAs. One is from Freetrade and one is from IG. Although they're both pretty new, I think, actually from this year. So yeah, I'd say HL is still the go-to. But if you do want to have your junior ISA and your adult accounts all on one platform, and also pay low fees, then I'd say look into IG and Freetrade. And yeah, I'll actually leave my top offers link down below. I update every month with broker offers because they do change quite frequently. And both of those right now do have an offer. So yeah, I'll link that down below if you want to check it out. The next one from Anthony says, another YouTube comment says, have you ever considered factor investing, even if just in satellite positions? So I'm not a fan really of thematic ETFs, which I covered in a recent video of the 7 things that I don't invest in. With factor investing, I actually have been looking into it more, particularly, and really the only one that I'm interested in, is global small cap value stocks. And really, because it's probably the last year or so now, but I've been watching more Ben Felix's videos, been doing my own reading into it, and ultimately, they have got historical long-term outperformance. Of course, small cap growth stocks have tended to do pretty terribly, but small cap value stocks have done very well. And even, I saw this mad stat, even in Japan, when there was the sort of 29-year period of no returns from 1989 onwards, when there was like multiple lost decades, nearly 3 lost decades, Japanese small cap stocks were up, I think like hundreds of %. So it just actually shows that maybe that is one factor where there could be outperformance. Because of all of that, in my brand new stocks and shares ISA, which I will be announcing hopefully soon on the channel, one of the ETFs that I'm investing into, there's only 2, but one of them is technically a factor type small cap fund. So watch out for that. Long story short though, it's only a very small part of my portfolio. I'm still not really a factor investor, but I have been looking into it more. I do understand that outperformance has historically been there. I think because of that, I'm gonna have a slight tilt in my portfolio, which I'll explain, TG for now, and I'll explain that in a future video. Another question from Instagram, this one's from Matt. Do you think long-term inflation will make a £1 million investment portfolio too little to retire on? I saw a really interesting article, this article from Vanguard the other day, which looks at who wants to be a millionaire. And when it first came out in 1998, of course, the prize was £1 million. It's still £1 million now, nearly 30 years later. And because of inflation, it's essentially halved. That's equivalent to £505,000 in real terms, which is pretty mental to think about. And I think now when I'm living off my investments, hopefully in 30 years time, that's gonna half again. So £1 million is definitely still a lot of money, but I do think if you are forecasting, 20, 30, 40 years into the future, then you would probably need realistically multiple millions of pounds in your overall investment portfolio, assuming you want to draw down 4% per year to cover your annual expenses. I think the difficulty is though, the 4% rule, which you mentioned already in this video, is a crude way to do it. But I think it really all just comes down to your monthly and annual outgoings. Because if you are more frugal and have lower fixed overheads, you're mortgage free, lower overall expenses, then you could actually build up a small investment portfolio and be financially free and cover all of your expenses. There's actually a really good book from Jack Bogle, the founder of Vanguard, called Enough, which is where people just accumulate forever and then never got enough and then essentially die with way too much money, which is a bit morbid. But long story short, I think £1 million is still a lot of money today and it will be in 20 or 30 years. But assuming that right now if you have £1 million, using the 4% rule, you could live off of £40,000 a year. So in 30 years time, you probably would need £80,000 per year, potentially, if inflation keeps going like it has been. And inflation generally averages 2 to 3%. Well, that's what's reported anyway. So you might need £2 million or £3 million in your total investment portfolio to actually cover your expenses. But I think, yeah, it all really comes back to your expenses. I might have butchered answering that one a little bit. It's still a lot of money, but me personally, I guess I probably would need more to cover my future monthly expenses, although I'm not sure what those monthly expenses will be because I've not got a house, not got a car, not got any kids. So yeah, for me personally, I'm not sure, but for you, potentially. Hope that helps a little bit. We've got another YouTube post comment from Stephen. He says, Ryan, thanks for the channel. I enjoy watching your videos and all the effort you put in for investing and forgetting. You can't really beat a world tracker. I agree, Stephen. If only I had started investing younger. Great to know they are still reducing fees. So there's a few bits to unpick here. Fees keep coming down, which is great across brokers and funds. So we really are paying rock bottom fees. Also in my new stocks and shares ISA I'll be sharing soon, I'm in an all world ETF, which is 0.07%. I've sort of broken one of my own rules there, but I will explain that in a future video. But I do agree with you. You can't really go wrong with an all-world tracker, a global index fund, particularly if you're in that wealth accumulation phase. You don't want to pick stocks. You don't want any bonds. You've got an emergency fund. You just really can all-world and chill or global index fund and chill. I think the difficulty is there's now so many options. And I would just say to people, don't get too bogged down. You know, ACWI, VWRP, the FTSE Global All Cap, the HSBC FTSE All World. They're all great options. They're all going to give a very similar returns over the long term. So pick the one that's on your platform, pick the one you like the most, pick the lowest fee one if that's what you favor, invest consistently and stick to it for the long term. And the last point that you made, Stephen, about wanting to start younger, I want to see this on a weekly basis. I think when it comes to investing, a lot of people will be accidentally investing already, fortunately, through their workplace pension. And if that is you and you've got one, you definitely want to log in, get access, potentially try and reduce your fees, maybe consolidate pots, switch what you're investing into. I personally switched away from both of my default funds. We actually go through all of that in the Investing Academy, and I've made previous videos on workplace pensions. But a lot of people are already investing accidentally through that, which is great. But also, it's always better to start later than never. So even if you're 40, 50, I mean, I speak to people who are 60 and they would just open up their first stocks and shares ISA. So it's never too late to start investing, even though you will have less time, of course, less time to compound your money. Even building up a smaller pot can potentially pay for some expenses in the future. You can pass it on. So in my opinion, even starting later or with a small amount, there's still only benefits. Another question on Instagram from Ben, can you show a rundown of how you will transition your wealth into wealth preservation assets? So this is actually a tough question. So I talk about quite a lot that I'm in the wealth accumulation phase, which is why essentially all of my money is in global index funds and ETFs. Some people actually say that approach is too safe, where I actually think I've taken enough risk. I could, of course, put it all into one stock or one theme or one country, but I'm still essentially 100% in the stock market with a little bit of crypto on the side. About 7% is in Bitcoin. The rest is in global index funds and ETFs. But I guess when you get to a point, you'll start living off of your investments, or even when you get close to that point, you will then have to start transitioning from wealth accumulation to wealth preservation. And I actually don't know how I would do this. I think thinking about it now, and of course this is probably going to be at least 20 years away for me, I would have a much larger emergency fund, probably 2 to 3 years worth of cash potentially, assuming I am living off of my investment portfolio and I have no real other income streams. And the second thing I'd probably do is I probably would put some of my money into bonds. Now, I've ummed and ahed about that, and I do change my opinion quite often about whether I actually would include bonds or not. Even though adding bonds, even 10% bonds, does reduce your future expected returns, at the same time, if there was a big drawdown or crash, you should, hypothetically speaking, although ignoring 2022, be insulated from the peakest or from the biggest drawdown, I guess. So what I'm trying to say is if you are fully in a global index equity fund, you probably will experience quite a few 30 to 40% crashes over a 4, 5, 6 decade investing time horizon. So the one way to stop those massive crashes is to have, I guess, more money in cash and more money in bonds. So I do think I would definitely have a larger cash buffer and potentially move some of my portfolio to bonds. It's so hard to say right now because, as I mentioned, I've not got, many responsibilities, no mortgage, no kids. So maybe it will be different in 20 years time. But right now, I do think that I would probably just keep investing fully in equities in my global stock market, index funds and ETFs, and have a much larger cash buffer. But it also depends on income. Stop waiting to start investing. If I'm getting some nice royalties from that in 20 years time, then I have income, so I could probably take more risk from my investment portfolio. But then if I was solely relying on my investment portfolio and had to survive 30, 40 years because I've retired, then I probably would need to de-risk. So it's one of those sort of financial planning questions. And actually, this is a side note. I've been thinking myself, it could actually be worth seeing a financial planner, just laying out all my cash and investments and everything, letting them know what my goals are and seeing what they would actually recommend me do. That's a bit of a side tangent, but I think that is how right now I would switch from wealth accumulation to wealth preservation. And I think when I would do that, it's probably when I'm close to hitting my number. And I say my number, I'm still really unsure what my specific number is because once again, my expenses are not very large at the moment because I've not got a mortgage, not got any kids, not got a car and all of that stuff. So it's very up in the air. But in the meantime, I'm just funneling money into global index funds and ETFs and I'll figure it out later. Perhaps not the best thing to admit as an investing channel, but yeah, that's the truth right now, and it might change in a few years' time. The next question from Connor, another one on Instagram. How much is too much for one shot of tequila? So, good question. And the backstory here is I was actually in Mexico for the World Cup. We unfortunately didn't get to a game. The Mexico games are reselling at 2K plus USD, which is mental. The Uzbekistan-Colombia game at the Azteca in Mexico City was the banker, but even that was $900 for resale and forking out, 700 quid for one game of football. Looking back now, probably should have done it, but at the time, it was one of those things that, yeah, we just didn't do. But tequila, surprisingly, Don Julio, the GOAT tequila, Don Julio 70, there were some places where it was £15 for a shot. Of course, everything was in pesos, so we didn't realise until afterwards. But I would say £15 is the most. But ideally, if you didn't get double digits, it's probably too much. So I'd say £9.50 is the maximum you want to be paying. I got a comment here from I got another lovely comment here saying, congrats on the subs achievement, Ryan. Love this channel and I've learned so much that I don't think I currently have any questions. I'm great to hear that. I also always see you commenting on my videos, so thank you very much. I genuinely really appreciate it. And if you or anyone else does have any questions, let me know in the comments or drop me an email. I'll flash my email up on screen. I might make it into a full video, a full podcast episode, and I'll always get back to you and try and help you out in the best way that I can. The final YouTube post comment was from Eleanor. And she says, I'd like a SIPP explainer refresher video with a comparison of platforms because Trading212 just added a SIPP option. Thanks and congrats on the 12K subs. So I actually probably should do a full video on SIPPs and I'll add it to my list and try and get a full video out on really how they work, the benefits. I think a lot of people probably do know that by now, as a lot of people, myself included, have been hammering that down people's throats online for many years. But you are right that the platform landscape and the best broker is always changing. I think with a SIPP, as we sort of mentioned at the start of the video, there are a lot of good now low-cost DIY options, being Trading212, Free Trade, and Invest Engine. I think it's just those three, and IG as well offer a SIPP. That's sort of the low-cost DIY brokers. I guess though the main downside of those platforms is, well, definitely the first three I mentioned, they don't offer limited company contributions. So if you want to do that, then they are completely off the table. If you don't want to do that though, or you just want to consolidate in an old pot, then really all three of those options are good. And it really comes back to, again, what do you want to invest into? Invest Engine just have ETFs. Trading212 have stocks and ETFs. Free Trade have stocks, ETFs, mutual funds, and gilts. So hopefully based on what you want to invest into, you can narrow the search down. If it is just a global ETF, then of course, all those options are going to be available still. And I think it then comes back to, do you want your SIPP and ISA all on one platform? If the answer is yes, then whatever platform you're currently using, you can just consolidate your SIPP into that platform. If the answer is no, and you want to spread your money around, which actually now my portfolio is getting larger, I do prefer doing that. Of course, all the brokers are regulated. It'd be very unlikely anything goes wrong, but I've started spreading my money around more brokers. So if you do want your SIPP and ISA on a different platform, then I don't know, using Invest Engine for your ISA, then you could use Free Trade or Trading212 for your SIPP, and that could be another way to think about it. But I do think it comes back to, again, start with the end in mind, what do you want to invest into? And if it is just a global ETF, then you probably, to be fair, you probably could just download all the apps or watch some video reviews on YouTube and just see which one you think you like the look and feel of the most. Of those low-cost DIY ones I've just mentioned, those low-cost DIY brokers, Trading212 have been around for the longest. They've been around for 20 plus years. I think Free Trade, they used to be called Fee Trade, but now they're back to being Free Trade because I've put a lot of their features no longer behind the paywall. I think they were around in 2017, and then Invest Engine was 2019, so they're much newer. If you want like an older broker, there's Trading212, but then they do offer CFDs, which you definitely want to stay away from, whereas the other two don't. So it's quite hard to say. But yeah, hopefully that gives you a few things to think about and can point you in the right direction. If you've got any more specific questions, let me know, and I'd happily point you in the right direction. I'll also leave that top offers broker link down below as well if you do want to sign up to any of those platforms. And I probably will make a full SIPP video. So thank you for the suggestion, and I'll write that down on my laptop now. Okay, that is all the YouTube post comments. So thank you for everyone who did comment on that post. I have got 2 more questions to go through from my Instagram story, and then I'll wrap up this Q&A. It's the first time I've done one of these as well, very unscripted and casual. So if you do like this style of video, please let me know and I can make sure I put more out. Simona has asked me about Marvell. What do you think about Marvell? Is it too late to buy the shares? I'm not gonna lie, I don't even know Marvell stock. Okay, so it is down 10% over the last day. They're listed on the NASDAQ. An American company headquartered in California, develops and produces semiconductors and related technology. They must have done well though over the last, yeah, oh my God, okay. 174% up year to date, 250% over the last year, and 330% over the last 5 years. So really the company has blown up in the last year. I guess like a lot of the semiconductor stocks, everything going on, but it's been listed since 2000. Wow, that is insane. And the stock essentially did nothing for, I mean, nearly 25 years. And this is the thing about individual stocks. I just don't think I've got the skill to pick them. And even if I do know a good company and can understand a company, it's more than actually timing the buying and selling. Because right now, just say you had put money into Marvell a year ago, you're up 240%. So that means you would have put money in before everyone else did, before it started going up. You then held when you made 10%. You held and made 100%. You'd have held 242% now. And that's the thing, do you keep holding? I guess you probably take profit, but then you'd have missed out on more gains. And that really is just why I stay away from individual stocks. So I don't think I've got the skill to be able to pick them, to be honest. But it's really the actual timing of the buying and selling. And I like to have things out of sight, out of mind, as stress-free as possible. A global index fund goes down, I put more money in, great, I buy more units. If it goes up, great, I've made money on paper. Whereas with these individual stocks, I'm not sure. And on this one specifically, I've genuinely got no idea. And I don't really think anyone else does either, because it is also hard to distinguish, and this is always an unpopular line when I say it, between skill and luck when it comes to individual stocks. So is it too late to buy? I mean, it might be. It's down 10% now though, so it could go up another 200%. Unfortunately, I've got no idea. If I had a crystal ball, though, don't get me wrong, I'd put all my money in the best investment, whether it was Bitcoin, gold, Marvell technology on the NASDAQ, whatever it is, but I just don't have that skill. And I think very few people do. So I just personally stay away from individual stocks. I didn't mean to go on a rant there, but long story short, and I should have just said this, I'm not sure, Simona, so I'm sorry. Okay, and the last question is from Jesse. I only invest in a global fund, the FTSE All Cap Accumulation. Legend, love that. Should I also invest in the FTSE 100? I live in the UK. Should you invest in the FTSE 100? The honest answer is you don't need to, but you could. And I guess that sort of goes for either this individual stock, and probably on this individual stock, for example, let's say you did invest in it, Simona, to go back to that question, you know, if it's 5-10% of your portfolio, you're probably fine. You might lose it all because it is quite hard, or you might at least underperform the market because it's quite hard to beat the market, but you're probably going to be fine if it's a small satellite position. It's when people put all of their money into one individual stock where it does get very risky. But coming back to Jesse's question on the FTSE 100, so with the FTSE Global All Cap, you are market cap weighted. So you invest roughly 3% into UK stocks because the UK makes up roughly 3% of the global stock market. If you want to have more exposure to the UK than just 3%, then you could add in a FTSE 100 or FTSE All Share index fund or ETF into your portfolio. Let's just say, for argument's sake, you have 50% the FTSE Global All Cap and 50% the FTSE All Share, then you would technically be overweight UK stocks because you'd have 3% UK stocks in the global fund and then 100% UK stocks in that FTSE All Share fund. So in total, you would be, what's that, 51.5% roughly in UK stocks. Now, it's one of those things where if the UK outperforms the rest of the stock market, you would have done very well. But if it doesn't, then you would do poorly, relatively speaking. Once again, I just don't know, and I'm probably beating a dead horse, and I say this every week on this channel, but I just don't know which country, which company, which sector, which industry is going to perform the best, which is why I simply just own market cap weighted global index funds and ETFs. Now, saying that though, if there are specific companies you believe in, if there are specific countries you do believe in, or maybe you just want to be patriotic and back UK stocks more, then the great thing about investing is you of course can invest into whatever you want. So you could put more money in the FTSE Global All Cap, make it, I don't know, 20% of your portfolio to be overweight UK stocks on purpose. And if UK stocks do outperform compared to the rest of the market, then of course you will do very well. The danger there is it's just so hard to know, and it is a bit of timing involved again. But I think if you set up a pie on Trading212, for example, and I don't know, have 80% in a global fund and 20% in a UK fund and do it consistently over time, that's probably the best way to go about it. Saying that though, just to be transparent, I personally, don't do that myself. I wish, of course, I had all my money in the US market over the last 10 years because that's been dominating. Now it seems to be a bit of a rotation away from the US and into emerging markets, but I just have no idea what's going to happen. And that's why I just stick to global index funds and ETFs. Probably not very sexy, but it's just what I do in reality. I have done for nearly 10 years now and will keep doing for the foreseeable future. This has been a very long video, so thank you, you've stuck to the end. But that wraps up these questions. So we went through 10, 15 questions there across Instagram or YouTube. A massive thank you again to everyone who has subscribed and watches my videos. I genuinely really appreciate it. As I mentioned at the start, I've been trying to increase the quantity and quality. So if there's any feedback you've got, constructive criticism, the video, the audio, just let me know in the comments or email me anytime. But yeah, I'll do that on there. Thanks for watching, thanks for listening, and I'll see you in the next one.